Attention aspiring final expense agents, if you're interested to learn the truth behind how final expense agent commission and pay works, then this video is absolutely for you. What we're going to be covering here right away are all of the intricacies and details about final expense commission. This is a very important video that you should watch if you are brand new to final expense or you're considering a career selling final expense, because this video is the most comprehensive resource that you're going to find that will pull back the layers of the onion in describing how final expense commission and pay works. So please sit back, take notes, and prepare to know the truth behind how final expense commission really works. My name is David Duford. I own DeFord Insurance Group, and I recruit final expense agents, new and experienced, whether they want to sell over the phone or in person. And if you're interested in learning more about how my agency works, go to davidduford.com/FAQ. So here's the topics of which we're going to be covering in detail as it relates to final expense commission levels for agents and how their payouts work. First, we're going to be talking about how commission is calculated. This is a really important factor that you've got to consider. Most agents have total confusion as to how that works, so we're going to go in detail there. Second is how advance commission works. This is what you get paid as a percentage of your total first-year commission. Most agents do not understand how advancing works, the speed at which it pays out, and some of the consequences associated with it. So we're going to talk in detail about that. And last but not least, we're going to talk about the common misrepresentations about final expense commission that many agencies perpetuate. There's so many agents who think they're paid one thing that are totally paid something different, and unfortunately it's not more than they think, it's a lot less. So we're going to spend some time kind of decompartmentalizing some of these realities and give you, again, empower you with the information to know exactly what your commission levels are and to know the facts behind what you can expect to be paid as a final expense agent. So the first thing we're going to cover is how exactly commission is calculated. And if you're new to final expense, you probably have seen that commission typically is represented as a percentage level. Now, what that percentage level is actually going to be is going to vary by all sorts of different items, depending on how much training you get, what kind of carriers are being offered, if you're getting lead subsidies to support or not. So what your commission level is going to be actually is going to vary, and we're going to talk about that in detail a little bit later. But the important thing is to understand, what is that commission level based off of? You may hear about some things like commission levels up to 140%. We've got the most aggressive commission levels in the industry. All of these are just kind of subjective. They don't really mean anything. And what you need to know are the facts behind how these percentage levels work. So the first thing to understand is that final expense agent commission is a percentage level that's based off of what's called the annualized premium. So what exactly is the annual premium? The annual premium can be best thought of as a monthly premium multiplied by 12 months. So if you're paying $100 a month for an insurance policy, let's say it's final expense, and you multiply it by 12 months, then your annual premium is $1,200. So what insurance companies do to determine what the payout to the agent's going to be is they take that annual premium, in this example $1,200, and then multiply it by the corresponding commission level for that particular product and carrier. So in this example, if it's a $1,200 annual premium your client pays, and you're at 100% commission level for that product, dollars in your pocket, if the plan stays on the books for the full year, is going to be $1,200. Also, final expense products do pay a renewal, and how it's calculated is exactly the same, except for renewal commission. The payout is always a lot less than the first year commission, because with final expense products, unlike, say, Medicare Advantage, which is residual-based policy commissions, final expense is a first year or front-loaded commission. So the residuals on final expense plans, in most cases, through year 2 through year 10, are going to pay somewhere between 3% and 8%, depending on the carrier and the product you're writing. So let's say it's a 5% commission on that $1,200 annual premium. 5% of $1,200 is $60, and that's paid what's called as earned, as the premium's collected monthly. So it's going to be a couple of dollars a month that you're going to get paid on a residual basis, and that is absolutely the norm as far as that range goes with final expense products across the board throughout most agencies. Now, again, some of you may have seen commission levels higher than 100%. Maybe you've seen commission levels way lower than 100% for final expense products. And again, what we're going to do here in a little while, stick with me please, is kind of pull back the layers here and describe kind of what is considered a good commission and what is considered a bad commission. And we'll also take some time answering the very oft asked question, how can you get paid more than 100%? Because there are carriers like what we do at the Ford Insurance Group. We pay commission with many of our carriers more than 100%. So if you're kind of curious or confused as to why and how that's possible, stick with me to the end. We'll definitely explain that in more detail. Along with commission levels, you also have to understand what advancing means. So the commission that you're paid is what you get paid for that full year if the plan sticks on the books, right? So back in our example, 100% times 1,200 gives you a first year dollar commission of $1,200 if the plan stays on the books, right? Well, the thing is when you make a sale, you very rarely get the full amount of money up front. Instead, you get what's called an advance on commission. And that is a percentage that is a function or based off of the anticipated payouts from the client in the form of premiums. And typically the advance commission with most products is going to be what's called 75%. Or if you're with guaranteed issue products, 50%. So in our example, we have that $1,200 annual premium. Well, if we have a 75% advance on a $1,200, in this case, commission we're going to get paid, 75% of $1,200 is $900. And in this case, when we write and close the deal, a couple of days after in most cases, what we're going to deposit in our bank account is not $1,200, it's $900. And again, in the same example, many guaranteed acceptance policies that are out there don't advance 75%, they advance 50%. So in the same example, 50% of $1,200 in annual premium is going to be, in this case, $600 in commission paid up front. And that's if the commission was 100%. So why don't the companies pay the full first year dollar commission up front? Why do they only advance or front you the money on 50% or 75%? Well, the reason is because an advance is not your earned commission. It's essentially a loan with the policy acting as collateral. You see, you don't actually earn that advance commission until the client pays, in most cases monthly with final expense, for the equivalent amount of months that that advance commission is relative to. So for example, a 75% advance takes 9 months before that advance balance clears off. And what happens is if your client charges back or they cancel, you owe back on that advance that you were paid, typically with most carriers, a prorated amount of money back to the carrier, because again, it's a loan against the collateral. Well, if that collateral goes away, well, you've got to pay back the balance that's not covered with premiums that the client has not paid. So for example, let's say Mildred, she buys this $1,200 plan, right? She pays on it for 3 months. We got paid $900. Well, we earned $300 of it, but then Mildred cancels the plan. We got paid $900. So what we have to owe back in this example is $900 advance minus the $300 we earned, which leaves us a $600 balance that's payable back to the company. So in case you're kind of alarmed, you don't actually in most cases have to write a check to pay off that balance immediately. Most companies give you 30 to 60 days to arrange a repayment. But in most cases, if you're still writing business, you don't ever have to cut a check. You just have to write more business. And that advance commission you would have gotten paid will then go cover that balance, that $600 balance. And until that's completely accounted for with new business, you won't get paid commission on. So once you make a sale, and let's say it's $1,000 that you would have been advanced, 75% of that, or $600 would have covered the debit balance, or the debit balance, and that remaining $400 would have been paid to you. And we'll talk more about chargebacks and some of the consequences in a little while, because it's a very important factor to consider when getting into the final expense space that very few agents seriously actually have a conversation with you about. So I'll make sure to spend some time at the end of this call describing the vast importance of making sure that you account for chargebacks and how to strategically reduce them, because if you don't have an intelligent approach to them, they can absolutely remove you from the business before you know it. A couple other factors to consider about advanced commissions, first of all, is the speed in which it is paid. Most carriers are either going to pay immediately within a couple of days after the policy is approved. We call this payable on issue. Or they're going to pay you after the first premium's collected, typically several weeks into the future after the first draft is successfully collected. So again, this is the difference between your cash flow rate. In most cases in any business, cash is king and cash flow is even more king. You want to get paid faster. Typically, the faster the better. And so when you choose a carrier to write with, the rate at which you get paid is going to be faster if it's set up to be on issue than it is to be paid on first premium, because in most cases, the way that final expense plans are set up is a buy now, pay later business. We get them approved and then typically set up the first draft to occur around when they get their Social Security or disability check. So a few last points here I want to cover with some common misrepresentations that many final expense agencies do when it comes to commission. This is going to be very important for you to listen to because, again, most agencies don't tell you the full story. They only give you a partial look at the realities of how pay works in the final expense business. And again, my goal with this video is to not pull any punches. I want you to understand exactly what you're getting into and how important it is to have transparency in how you're going to get paid, at what rate you're going to get paid, and some things that you need to consider as you do your due diligence to find the right agency to join to sell final expense with. So one of the biggest misrepresentations that are perpetrated throughout this industry, especially with one of the bigger players that recruit agents nationally, that probably you have heard of or maybe even consider joining, is this allegation that you're going to be at an XYZ commission level. And the XYZ is the three-letter acronym that refers to the agency. The way that this agency works, and others do this too, is they say you're at the XYZ 100 level and you're at the XYZ 100% commission level. And the insinuation is that all of your carriers are going to pay 100%. And again, a lot of recruiters do this to, again, simplify the explanation of commissions, because commissions can kind of bog down in explaining things, that their perception at least, is that this whole disclosure stuff bogs down the process of getting people on board and getting running. And so they willingly, in my opinion, misrepresent the totality of commission. Well, the truth behind how these commission levels work when they say it's the XYZ 100% commission level is it's really only that commission level for a small selection of carriers. For example, the big player that I'm thinking of that I won't mention here, but you probably know who I'm talking about, the commission levels that actually pay 100% are only limited to one or two carriers in the final expense space. And those aren't necessarily the best choices. And then if you start looking at their options for coverage with other carriers, what you find is the carriers you really want to use to get your client the best combination of price and coverage actually are going to pay 20 to 40% less commission. So I think at the end of the day, if you're being told right up front that your commission is XYZ 100, let's say in this example, and then it's not, that's misrepresentation. And if they're going to misrepresent what your commission levels are in the beginning, what else are they going to misrepresent? So I think it's disingenuous. I think that you should heed caution to the wind when a relationship in business is started without full transparency. So a couple of things you can do to get some clarity on what your actual commission levels are is that for any agency that you're looking to join, make sure that you ask for the actual commission grids associated with the carriers that you're going to be working with. Again, what this allows you to do is to take what they've claimed your commission levels are, and it's going to allow you to compare it to what it actually is going to be. So for example, at DeFord Insurance Group, in the FAQ page for agents that I send to check out how my agency works, to get a good idea if it's a good fit or not, as well as the onboarding process, there are opportunities to look at a spreadsheet we've designed that go through all of our major final expense carriers that actually list out the commission levels on first year and residual basis. And then there's links to actual commission grids that show what the breakdown is at all ages and for all products. And the point of doing this is that I want, as agents join my agency, to have full transparency, and I want them to do their full due diligence. Again, I don't want to mislead our agents in the sense that they're going to be paid one thing and it's entirely different altogether. That is not a way to have a business relationship, certainly at all, but certainly not long term. So transparency is key. Make sure you hold people's feet to the fire when they claim they're going to get paid one way. Make sure you trust, but cut the cards, as they say. Another thing that a lot of agents wonder, and sometimes agencies propagate to undercut agents from getting paid well, is how can you get paid more than 100% of the commission? Well, this is a misunderstanding of what the commission is based off of. Again, the real question you should ask is, okay, this is your percentage, but what is that percentage a function of? Is that percentage a function of the total commission payout in dollars, or is it a function of something else? And if you recall from earlier, the way that commission and final expense and most life products for that matter are determined is as a percentage of what's called the annual premium. So if it's a percentage of the annual premium, it's not a percentage of all the commissions that are paid out. So in other words, the commission percentage can be higher. And that just means it'll pay a higher commission than what the premiums have come in. And many people wonder, well, how's that possible? Why would a company pay out more in commission than dollars received in premium? And my answer to that is very simple. Insurance companies have a long trajectory before they become net profitable on the business that they write, which seems kind of strange, but it takes many times 5 to 10 years, depending on the carrier, before the company is net profitable on a block of business written. And a big chunk of that expense is anticipated and expected to be in the form of commission that's paid to the agent, the IMO, and the whole downline sales hierarchy. And they factor that into their product. And then what happens is, as you can see with the renewals we talked about earlier, they pay a lot less in renewals than they do first year. So that's when the company starts to gain revenue and begins to breach the break-even point to where it becomes a profitable enterprise. But again, insurance companies operate over the long haul. They're not worried necessarily about making an immediate profit off of the sale of their products. They're in it for the long term. So I assure you, don't worry about it. They all make money. And yes, you can absolutely get paid more than 100% on the commission rates, because it's not a function of the total commission paid out. It's a function of what the annual premium is. So the last thing I want to talk about before we wrap this up is very important. That is the concept and the reality of chargebacks. And again, if it wasn't clear earlier, chargebacks are what you owe back based off of a policy lapsing in most cases. And if you write poor business, or if you choose poor or inferiorly priced carriers to write on your clients, you're risking yourself having chargebacks. So again, one of the things I teach at DeFord Insurance Group is to be a broker, to truly have a representation of multiple carriers that are a good cross-section of competitively priced, very good underwriting niches, and easy to use. And it's because of this strategy we're able to greatly minimize our chargeback issues that many other agencies out there who don't adhere to these principles experience on a large basis. For example, I'll mention the IMO again from earlier, again without mentioning their name. They push a high-priced product as the best thing ever since sliced bread product for the final expense type of sale. And what commonly happens, what you don't hear from behind the scenes, is that because the price is so very high, is that if some other agent walks in the door behind you and they're halfway good at selling, your client most likely is going to drop that overpriced plan and to select a more competitively priced plan that new agent represents. Now, why do clients do this? Because they're on a fixed income. They want to get the best deal that their money can buy, and it's not personal, it's just business. But my point is, you don't want to be in these positions to where you're exposing yourself to an abnormally high amount of chargeback risk. Again, a good strategy like what I teach my agents is to go into a house and sell as if you absolutely know with perfect knowledge that another agent who's good at this business is coming behind you in the next 3 months. If you knew a really good agent was coming behind you the next 3 months, how would that change what products you selected for your client? How would that change how you sell, right? And so the idea here is to strategically operate your business to minimize this chargeback risk. And again, I mention this because not every agency thinks this way. They push a particular product because it's chock full of bonuses. It has high commission payouts for management and upper management, and you wouldn't know any better because you're brand new and you just trust the folks that bring you on. But they're kind of leading you astray in a sense, and it becomes a risk that becomes much higher in propensity and actuality when you write overpriced plans. Thank you so much for watching, guys. I hope this video gave you proper perspective on how final expense agent commission and pay works. Again, my recommendation, whether you join my agency or somebody else's, is make sure that you do your due diligence. Make sure the choice that you're looking at reflects everything in your values and that it's going to be a good choice. Don't just go with one company without questioning things. Ask around, look at interviewing with different agencies, try to find the best fit for you, because this business is absolutely awesome. You do not want to squander this opportunity that really 90% of new agents fail because you rushed into love and you didn't do the slow due diligence thing to make sure that the pick that you selected was really the best. If, again, you're interested in learning more about my agency, go to daviddeford.com/FAQ to learn more, and thanks for watching.